So we are going to get started. My name is Helen Weber. I am the Director of Nonprofit Services at HW&Co, and I welcome you to our virtual nonprofit Guide to Success. Introduce our next speakers. We have two in this next session for contribution revenue recognition. Dan and Asim are both members of the Accounting and Auditing Advisors Group at HW&Co, and they are well-versed in issues facing nonprofit organizations and have guided clients through recent accounting and reporting changes, especially those that they are going to discuss today.
So Asim and I, as Helen mentioned, are going to cover the contribution standard that went into effect for our 12/31/19 year ends and our 6/30/20 year ends. So, Helen covered a lot of this with CPE and unanswered questions, so we'll kind of skip through that. So really what we're going to cover is Asim's going to go through the contribution standard, ASU 2018-08, and also touch briefly on the revenue recognition standard, ASU 2014-09. We'll go through a flow chart here that shows that depending how the things come in, it will either flow through to one standard or the other. So we want to make sure, even though our presentation is really focusing on the contribution standard, that we at least touch on the revenue recognition side of things. And once Asim kind of goes through the basics and the standards, I'm going to go through some real life examples along with a spreadsheet we've put together internally that helps track the different contributions you get in, so you can better track, should you recognize them in what period, are they restricted, what are the restrictions? So I'll go through that, and then also some footnote examples that we have that we think can be beneficial, just to show the different varying levels of detail that are out there depending on what type of revenue is being recognized. And at that point, I'm going to switch everything over to Asim. And Asim, you should have control.
Thank you, Dan. I don't think I do. Let's see. I'm not seeing the control. Can you guys see my screen? Oh, there you go. I think I might have it now. Can you guys see my screen now?
I think so, because it looks like you are moving through the slides.
Yes. So as Dan mentioned, we'll cover two accounting standards during the presentation today. The ASU 2018-08, which is related to the contributions, and the second one, very briefly, the revenue recognition ASU, the ASU 2014-09.
Asim, I just wanted to remind anybody that is looking for the handout, on your sidebar, you'll see there's a section for handouts, and there's it'll say Kaminsky FOPP, like PowerPoint, and it's a PDF. If you just click on that, you'll be able to download it and have your handout. Okay, I think that she'll answer the question.
Thank you. Starting with we'll start our presentation with the contribution standard, the ASU 2018-08. Start looking through the effective dates for the ASU. The ASU contribution received portion of the standard was implemented in 2018 for public entities and entities with non-for-profit entities with a conduit bond obligor. So those had the standard implemented in effective June 15, 2018. So in 2019 was the first calendar year the standard was implemented. And then for all the other entities the 2018 was for public entities, and for all the other entities was January 1st, 2019, when the standard was implemented. So most of our audience probably had the standard implemented already in 2019, but again, we were getting a lot of questions, and we just wanted to revisit the standard and go through some of the key topics, key areas related to the standard to help the non-for-profit clients recognize the contributions and then implement the standard more effectively going forward. And the second piece of the ASU is related to contributions made. And we won't spend too much time on that portion, that piece of ASU. The ASU will be effective the 2020, 1/1/2020, so 2020 year ends for non-for-profit entities, and then it was all implemented in 2019 for public business entities and the entities with conduit public bond obligors. Like I said, we won't spend too much time. I don't think we have any slides on the contributions made piece, since majority of our organizations and the audience members the first portion, the contribution received portion, is probably more impactful to their financials and the contributions made. The early adoption for the standard was permitted. The next one, as Dan mentioned, we'll briefly touch on this standard because it does come in play with the contribution received standard as well. But we won't spend too much time on this because the standard has been out there for a number of years. As we can tell, it was 2014 when the first time it was actually issued, and then there were a lot of back and forth changes. So this standard has been out there for a number of years, and we have been talking about this standard for a number of years because it was such a big ASU and had some changes to the financial statements for a number of organizations, added a bunch of additional footnote disclosures. So we have been talking about this center for last couple of years. So I won't spend too much time. So briefly, just going over the center in the next couple of slides, like quick refresher for everyone in a way. So the effective date for the standard for public entities and again non-for-profits with those conduit public bonds was fiscal years beginning after December 15, 2017. So effective 1/1/2018 is when this ASU was implemented for those entities, and we had a number of organizations within our firm that implemented the standard for 2018 fiscal year. So we did have a number of those, and all of the entities, it was the effective date was January 1st, 2019. And also with that too, we had a number of entities that had implemented the standard for 2019 fiscal year. Most of those entities were that had issued the statements very early portion of 2020 had implemented the standard in effective 1/1/2019. And for all the other organizations that were planning on implementing this standard, and I'm sure everyone saw that during 2020, June 2020, due to COVID, FASB did defer the implementation date for this standard one more year. So for all the organizations that didn't implement the standard in 2019, and all these 630 clients, the FASB did push the implementation date by 1 year. So for everyone else that has not implemented, they will implement the standard 1/1/2020 next year. So like I said, we already have a number of organizations that implemented the standard, and some of the biggest changes that we have seen, not material changes on the financial, were like true number changes, but the audit statements did result in about a page and a half or 2 pages of additional disclosure footnotes that were needed under this ASU. So that's one of the big changes that you will see for your organization that did not implement the standard in 2019. So in 2020, you'll see additional footnote disclosures in the financial statements going forward for the standard. And what this standard impacts? It impacts all contract with customers except the number of contracts listed here, such as lease, insurance, financial instruments, guarantees, non-monetary exchanges. And so those are excluded because all of these sort of contracts are covered under different ASUs. So FASB did not include those in the same ASU because they have a separate accounting standards just specifically for these contracts. So they're excluded. and contracts not with customers are also excluded. I'm sorry. Quick core principle for this ASU. I'm sure everyone is familiar with these 5 steps for this accounting standard. It's just a quick principle of how and when to recognize revenue. First step, identify the contract with the customer, identify performance obligations within the contract. The third step, determine the transaction price. And then if your contract has multiple performance obligations, you have to allocate the transaction price between those performance obligations. And lastly, recognize revenue as a performance obligation is satisfied. So again, everyone is most of you guys who are familiar with this 5-step process to identify when and how you have to recognize revenue under this accounting standard ASU 2014-09. With that, I think we're ready to launch our first polling question. Helen, are you launching the question or?
Yeah, you know what? I'm sorry. If you're the presenter, you don't see it. So the question is
Okay.
launched. It's my organization will have revenue that falls under, and the choices are revenue recognition, contribution standard, both, or neither. We'll give you about 30 seconds to answer, and then I will let you know the results.
Thank you.
And the results are almost half, 48% are both.
Okay.
31% is revenue recognition, only 7% is standard, the contribution standard, and 14% are neither.
Yeah, I mean, that's pretty reasonable because we would expect that number of revenue recognition by most of these organization contribution. If your organization doesn't receive many contributions or many significant contribution, the ASU probably won't impact you significantly. And then both as well, if you have revenue recognition, which will be implemented, and then if you have decent number of contribution, you receive significant number of contributions during the year, so you'll be implementing both standards. So that makes sense. Now we'll dive into our next ASU, the ASU 2018-08 contribution guidance. As Dan mentioned, I'll cover some of the basics, some of the information on the standard in the next couple of slides, and I'll give you brief, small examples here and there, and then Dan, at the end of my session, will go through and give you guys some real-world examples on how to treat those transactions under this standard. So in this slides, we see some of the important concepts for the standard. One of the biggest one is exchange transactions versus contributions. So what are exchange transactions? Transactions where a resource provider receives a commensurate value for assets transferred. So the foundation or a contributor who's giving your organization money, in return, they're receiving something as well. So if you have any sort of contributions like that, those are considered exchange transactions because the contributor or resource provider is also receiving something in return. And on other hand, contribution are transaction where resource provider does not receive any value in return. So that's one of the biggest difference between exchange transaction and contributions. And then we'll give you guys an example to identify transactions that fall into each category that are in the presentation. The next concept is unconditional contribution promises to give. Those are unconditional transfer of cash or other assets, as well as unconditional promises to give. So you receive money with no conditions, no sort of barriers or restrictions on that contributions. Next, number 4, donor-imposed restrictions. Those are donor stipulations that specify a use for a contributed asset that is more specific than broad limits resulting from the following: the nature of non-for-profit entity, the environment it operates in, and the purpose. So those, I'm sure everyone is familiar with donor imposed restrictions. Those are usually the purpose of the contributions, time restrictions. Those are some of the examples of the donor imposed restrictions on a contribution. Next, conditional contribution. So we already looked into unconditional contribution, but what is a conditional contribution? Promise to give. A promise to give or a contribution that is subject to a donor imposed condition. A conditional contribution must have both. It will have a barrier and it will have a right of release or return of funds. We're looking to different kinds of barriers, but we could have a performance-related barrier, such as a contribution. To get the contribution, you would have to achieve a certain level of service of a sort before the monies or assets are transferred, or the other sorts of barriers are like matching requirements. So there are contributions that would say an organization will receive such and such funds if that organization can go out and get funding from other organizations for a certain value. So the matching requirements. So those are some examples of barriers. And right to release, you may have seen sometimes in the contract that says the assets not used during the time period will go back to the resource provider. So those are some examples of right to release. So for a contribution to be a conditional contribution, it must have a barrier or barriers and a right of release, return of funds. Right here, we just said barriers, they're more stringent, more specific than donor imposed restrictions. And like I said, we'll look at some of the examples there shortly as well. Next slide. This is a great starting point for everyone when they're trying to differentiate between an exchange transaction and contribution, unconditional, conditional. This contribution decision tree is a great starting point for that. As we can see, maybe I can make this a little bigger here. So for each transaction, we'll start with step 1, is transaction in which each party directly receive commensurate value. If it's no, we'll move to next step. If it's yes, that's where the revenue recognition standard comes in play, where it's an exchange transaction, and we will apply topic 606 on revenue from contract with customers. And that's where Dan was referring to, where based on this decision tree, you could have a transaction that falls under the revenue recognition. And then if it's not an exchange transaction, it'll be under this accounting standard. And then we'll follow the same decision tree. On the next step, if it does not have a value, is the payment a transfer of assets that is part of existing exchange transaction between a recipient and unidentified customer, or another transaction outside the scope of contribution received? If it's yes, it's outside the scope of this subtopic. Other accounting standards will be applied on a transaction. If it's no, we'll keep going, and we will apply the contribution guidance for the transaction. Next, we'll look into if there's a donor imposed condition or a conditions present for the transaction. If it's yes, it's a conditional contribution, recognize revenue when the condition or conditions are met. If it's no, it's an unconditional contribution, recognize revenue in appropriate net class, net asset class. If there are restrictions, we will present it as with donor restrictions. And if there are no restrictions on contribution, we'll do it without donor restrictions. Like I said, this decision tree is a great starting point for everyone that is trying to analyze a transaction and see where that contribution or grant will fall. This decision tree is a great starting point for that. And on next slide, next couple of slides, we'll walk through these steps to determine when and where the contribution should be recognized. Step 1, determining exchange transaction versus contribution. And if it's a contribution, we'll go to step 2. If an exchange transaction, like we discussed, will fall under the revenue recognition guidance. Step 2, conditional versus unconditional contribution. Once unconditional, move to step 3, determine with or without donor. And if it's conditional, we will recognize revenue when the conditions have met. Step 1, Step 1, determine exchange transaction versus contribution transactions. Like we discussed already, resource provider must receive a commensurate value for it to be an exchange transaction. When you're analyzing a transaction, you should think who is receiving the value or benefit from this. If it's an indirect value based on social benefit or furthering the mission of a resource provider, it is not commensurate value. That will be a contribution, not an exchange transaction. And this is where we are starting at the top of the decision tree on this step 1. Determining exchange, there are 2 examples that we took from the accounting standard from the codification. Example of an exchange transaction. A local government funds a non-for-profit for research on benefits for a longer school year. The local government retains the right to study findings and receive direct benefit of work performed. Since the local government is the one who's retaining the rights and receiving the benefit for the research, this will be considered an exchange transaction. And here's an example of when it's not an exchange transaction where federal government grant paid to university for a research. The university retains the rights to research finding and receives direct benefit. Federal government's benefit is indirect since research serves general public. Since the research is not for the government, the government does not have the rights to those research, the university does, and it's for the benefit of general public. This will be an example of a contribution, not an exchange transaction. On next page, see federal and other government grants. Most of the government grants are not considered exchange transactions anymore. They will be considered donor restricted conditional contributions, but they're not usually considered exchange transactions. Timing of revenue being recognized is expected to not change because government grants are mostly awarded on cost reimbursement basis. You expend the funds first before you receive government funding, so the revenue is generated when incurring those costs. No changes to current accounting or giving relief from disclosures of the new revenue recognition standard. So that's good. Again, most government grants, there might still be a grant or 2 that your organization had that may still consider exchange transaction, but most are not considered exchange transactions, are considered contributions. Here's some indicators that there is a commensurate value. Expressed intent asserted by both recipient and resource provider to exchange goods and services. Recipient provides valuable patents or other results back to resource provider, and the resource provider retains the sole rights to use those patents or results. That's an example of example we just reviewed a couple slides ago, where the local government retained the rights. So that's an indicator. Transfer of assets that are part of an existing exchange transaction between a recipient or identified customers. So third-party reimbursements under Medicaid and Medicaid are considered exchange transactions for those reasons. And that's why they fall under the revenue recognition. So the organizations that have implemented the revenue standard, they know that the Medicaid and Medicare reimbursement resulted in a disclosure footnote under the revenue recognition, not under, it won't be considered under this ASU, the contribution ASU. Example of indicators that there's not commensurate value. The recipient of the value is general public. Again, that's an example what we saw a couple slides ago. Execution of resource providers' mission or positive sentiment. Sentiment from acting as a donor is not a commensurate value. If resource provider has full discretion in determining the amount of transferred assets, the recipient, not the resource provider, controls and retains the right to activities carried out under the agreement. And lastly, value received by the resource provider is incidental. And this is what we just performed in the last couple of slides. Helen, I think we're ready for the second polling question.
Okay. So the polling question is, my organization receives revenue with donor restrictions. Almost, and the choices are almost exclusively, on a regular basis, infrequently, or never. Our results, overwhelmingly, it's on a regular basis at 64%, then infrequently at 23%, never 11%, and almost exclusively is only 2%.
Yeah, that makes sense. A lot of these contributions or grants received by organizations do have some sort of restriction with the contribution. So that definitely is in line with our expectations for a number of these non-for-profit organizations. So moving along with the slides, step 2, determining conditional versus unconditional. Again, conditional agreements includes both a barrier and either rights of release or right of return, asset return, or release or promise to give. What are some indicators for barriers? Measurable performance requirement before entitlement to assets. Stipulations related to the purpose of the agreement, limiting recipient discretion in conducting an activity. Extent to which a stipulation is related to the purpose of the agreement. And lastly, other barriers such as matching requirements. Here are some examples of measurable barriers. Foundation grant for career training to disabled veterans. A specific level of service with specific minimum target that must be met is a barrier on which entitlement depends. Likelihood of servicing those minimum is not considered. So in this example, the grant would have probably said, like, to receive the funds, you have to perform or train a specific number of veterans, disabled veterans, to receive those funds. So that's a measurable barrier because there's a number associated with the grant monies. Here's an example of matching contribution measurable barrier. Senior living facility received a letter for a promise of $250,000 for their assisted living addition. No specific performance or measures included in the letter. In the letter, it stipulates that facility must first obtain another $250,000 from individual sources to receive this contribution. So in this case, they received a letter for a promise 250. However, to get that 250, they have to go out and get another 250 from individual sources. So that's an example of other matching contribution barrier. Next, we have best examples of best effort matrix foundation grant for recreational organizations tennis program. Consistent with grant proposal, contains guidelines with matrix about how to use funds towards the program. However, entitlement is not dependent upon meeting those guidelines, as long as the funds are used towards the program. And next, we're going to look into donor-imposed conditions, determining restricted versus unrestricted, or with or without restrictions. Restrictions limit the use of the funds, limit the activity to be performed. They do not affect whether the recipient is entitled to the contributions. The specified activity is narrow in scope and the mission of non-for-profit. Disclosure for conditional contributions, promises to give, required to disclose the total amount promised. A description and amount of each group of promises have similar characteristics. A donor-imposed condition must have both one or more barrier that must be overcome before a recipient is entitled to asset transferred or promised, a right of return to the contributor for asset transferred, or right of release of the promise from its obligation or to transfer assets. I think we have already discussed this slide and information on this slide on for donor imposed conditions to exist. The barrier must be present and a specific right of release or must be present as well. So step 3 is just restrictions versus unrestrictions for those contributions. With that, I'm gonna pass it to Dan, who will go over the spreadsheet that he had mentioned earlier and give you guys some examples of the real world examples for this accounting standard. So Dan, I think let me see if I can give you the control.
Helen, you want to launch our third polling question while it seems switching the controls over?
Good idea. So the polling question is, grant reporting would typically be considered a barrier to recording a contribution. Please select one. Is that true or false? Seem you're testing us. We had to be paying attention.
Yes.
And the results are in the, looks like 71% of the people said it was false and 29% thought it was true.
It is false, so the 29% weren't paying attention to you. I'm sorry.
And I think,
not too
Dan,
bad.
I just need you to share your screen so we can see your slides. There we go. Perfect.
Okay. You can see the slides.
Yes, we can. We're good now.
So we're going to go through some real world examples here. And, it's great in theory to go through the examples that the standard presents, but I think sometimes what actually seems to be out there is easier to go through. So, and we've also put together, as I mentioned, a spreadsheet that we think helps to kind of break down each of these different, grants or contributions or exchange transactions to just cover all the key steps in the standard as far as recognizing everything. So again, in this first example, a nonprofit receives a grant from a private foundation for $50,000 to be used at their discretion. So in this case, there's no barrier that they have to overcome. So the organization can then recognize that revenue immediately. And again, there's no restriction on the grant. It's at the organization's discretion. So the revenue is recorded without donor restrictions. I'm sure everyone would love to only get these type of contributions, but not really the case. So can everyone see the Excel sheet, Helen?
We can.
Okay,
Yes.
great. So you'll see here we kind of go through, when was if you start on the left, what trial balance account did you record it in? Who's the granting organization or donor? The date, the amount, any specific period that's covered, and these are the other examples we'll go through. When did you receive the cash, or when do you expect to receive the cash? And then going through step one, is it a contribution, an exchange transaction, or an other transaction? In this case, it's a contribution. We then move to step two, and again, listing any reference to any donor imposed conditions, whether it's a barrier, right to return, release. So in this case, based on review of the grant agreement, there's no barriers. It was without restriction. It can be used at the organization's discretion. Is it a conditional contribution? No. Were the barriers met? If there were barriers in this case, that's not applicable because we didn't have any barriers. And then moving into step three, again, reference to any just donor imposed restrictions. In this case, there were none. How much would you record in the current year? How much was recorded in the current year? If we were auditing this, what was the amount that should be? And then is there any potential adjustment? And then how much would you expect to record in future years? And then again, how much was without donor restriction, what was recorded, and then what would be with donor restriction in the last column. So that's an easier example. Some of these aren't quite that straightforward. In example two, the nonprofit receives a grant from a private foundation that's to be used for their youth program in 2020. The grant does require grant reporting, and if the funds aren't used, there's a right of return. So in this case, there's no barrier to overcome. The organization can recognize the revenue immediately. As we mentioned, the grant reporting is not a barrier. However, there is a specified purpose for the grant, so you would record it with donor restrictions. And then it also has a timing restriction that is for 2020 for the youth program. The right of return also exists if the funds aren't used for the purpose specified in the grant. Now, a lot of times what we see is, when a grant comes in with a restriction, as long as if it comes in 2020 and it's used in 2020, most of our clients, what we see, they record that as unrestricted. They don't record the temporary with restriction, then the release. Then that's usually disclosed in the financials, which is fine. For purposes of this example, I didn't do it that way just to show it coming through on the spreadsheet. So again, listing all the information about the grant, breaking down the different, in this case, there's no barriers, but the grant has grant reporting, has a right to return. There are restrictions on it. Just all the kind of key pieces of information would go in this step two section here. And again, conditional because you had to meet those specifications. So yes, it was conditional. We didn't have barriers. Noting there is a purpose and timing restriction. And then again, what the amounts are and what categories it would go in this case without restriction because we assumed funds were expended in 2020 for the program. Again, that's what we see most of the time in our client base. Example three. So in this case, the nonprofit receives a grant from the U.S. Department of Veteran Affairs to provide support for homeless veterans. They're going to get $300,000 for the year. The organization will then bill the VA each month for services that they provide. So in this case, this would not fall under the contribution standard. It's really an exchange transaction. They're providing a service, and then they're going to bill for that service. So it would really fall under topic 606, which is the revenue recognition standard. And you would then recognize that revenue under accordance with that standard. So again, if you look at how we put it on the schedule, you still fill it out, with who it's from, the amounts, Except here, instead of listing as a contribution, we'd have exchange transaction, and then most of the rest of the spreadsheet falls in as NA because we're not dealing with barriers and those things because you really don't follow that contribution standard with that type of revenue that comes in. The fourth example, the nonprofit receives a notification of a grant from a federal agency that they're going to receive $150,000 to replace all the lighting in their building. But the grant specifies they must get the other 150. They're anticipating a $300,000 cost from other sources. And then a grant report must be completed once all funds are met. The grant funding was received, grant was received in 2020, but the matching funds aren't expected to be received until 2021. In this case, you have a matching requirement, which is seen mentioned is one of the types of barriers we'll often see when we see these contributions and grants coming in. And so as a result of that, you wouldn't recognize the revenue until you overcome that barrier, in which case you don't receive the matching funds, which as said here, you don't expect to get those matching funds until 2021. So once that matching requirement is met, you'd recognize the revenue, but you still have the donor restriction until those funds are used for the appropriate purpose. And again, the grant report is not a barrier. So when we go back to our spreadsheet here, for example 4, again, no specified period mentioned. You get the cash upon receipt of the matching funds. Noting here in step 2 that there is a barrier to overcome the revenue. Again, it's conditional, but their barriers were not met. And so then when we come over to this part, again, you wouldn't record any revenue in the current year because you don't expect it. You're not going to meet that barrier. So you'd note that the $150,000 is going to be received in a future period. And again, not recorded here in either category because you're not recording the revenue in the current year. I guess there is a scenario where if you had gotten the cash, you may have deferred revenue. If you get the cash in 2020, but you can't recognize it until 2021 when you get that those matching funds. So you may have a deferred revenue that you have to record in that situation, but you wouldn't record the revenue until you overcome that barrier. Example 5, a nonprofit receives a letter from an individual notifying them that the nonprofit will be a beneficiary in their will and that they're going to receive $500,000 upon this individual's death. We have multiple barriers here that have to be overcome. One, the individual has to pass away. And second of all, the will can't be modified or changed prior to that individual's death. The notification of being in the will isn't a reason to recognize that revenue until that person passes away and you actually get notified that the final will is the case. You don't recognize that revenue. And again, in this case, and with all the cases where the revenue isn't being recognized, disclosure in the financials would be considered based on the materiality of the contribution. So again, in this case, adding it to our schedule, knowing it's contingent upon the individual's death and the will not being changed, and knowing that the amounts will be recorded in a future period, that you wouldn't recognize that revenue in the current year. That's sixth and last different example. A nonprofit receives a letter from a foundation that they're going to make contributions to the nonprofit of $300,000 equally over the next 3 years, $100,000 each year. There's no barrier in the grant agreement, so the revenue can be recognized. However, there's a time restriction because, again, they're saying it's going to be over a 3-year period. So the restriction on the revenue is released over time. So you'd record the first $100,000 in the current year as a contribution without restrictions, and the remaining $200,000 would be with restrictions. And then you'd also have to present value those future amounts. So that $200,000, you'd present value it back to the current year. Again, if that's material, depending how far out you're going, you wouldn't record the gross amount. So again, coming back to, I didn't calculate the present value for purposes of the spreadsheet here, but again, knowing the $300,000 contribution, what periods you'd receive it, what the barriers are, excuse me. Again, is it conditional? No. It has a purpose and timing restriction. And again, you record 100 in the current year and 200,000 in future years. And then again, 100 with restriction, 200 without. And then just a couple examples of what your footnote might look like. In a lot of cases, as when we did that poll, a lot of organizations are getting revenue that falls under the revenue recognition standard and revenue that falls under the contribution standard. So in this case, this footnote would go through talking about first the revenue recognition standard, where there's a service being provided that they're then billing to different organizations, and knowing that revenue is recognized as those performance obligations are satisfied. The second part of this footnote goes into the contributions that they receive from private foundations, from individuals, and again, not recording those contributions until all conditions are satisfied. In a lot of cases, we'll see nonprofits have special events. So we also have a part of that note where they disclose that they have special events, that they receive, ticket sales and sponsorships, that they establish the prices for those events, and the revenue is not recognized until the event has concluded. And again, that revenue is conditional upon occurrence of the event, and that those amounts are received in advance and recorded as deferred revenue. And that's a little more basic, just a couple different types of revenue. Compared to this footnote here, you'll see it's multiple different types of revenue. The first part of the note talks about how the organization, again, receives revenue from grants from federal, state, and local governments under these programs, how those amounts are recorded, that if there's, grant receivables, if other they're collectible, is there an allowance, going through that information. Again, the second part talks about grant revenue with terms and conditions aren't recorded until those conditions are satisfied. And again, that revenue might be subject to review by the federal funding agency and could be, disallowed in future periods. Then moving into our contribution note, talking about contributions recognized when promised unless there's conditions. Again, talking about those restrictions and the releases. And then the fourth paragraph just talking about that they do have conditional grants and contributions. They have to, meet those barriers to record that revenue. That they don't record those until those conditions are met. And then also disclosing what those conditional grants are, as they've, in this case, it would have been material to the financial statements. So again, these grants can be very complicated, and I think that's why we think that, that spreadsheet can be very helpful, or something similar that might just to track instead of, otherwise there's just too much with these different standards to try to track it all without using some type of spreadsheet. And we can provide this. If it's something you're interested in, please email Asim or I, and we can provide something to you to use internally. And then I think we have one more polling question, Helen.
The last polling question is, have you seen a decrease in contributions from donors in 2020? So yes, no, and no change. And the answers are the 52% have seen a decrease, and then in the rest is almost split equally between no and no change.
I don't know if there's any questions in the chat for Asim or I. Helen,
At this point, I do not see any questions.
Okay. Like I said, if that spreadsheet's something you think would be helpful, let us know. Or if there's any other questions, we'll be happy to answer them. Otherwise, I think we are up against our time.
Yes, perfectly planned, I think, Dan and Asim.
Did our best.
So if you have any questions for Dan and Asim, I think if you forward to the next slide, you can see their contact information. If you think about something afterwards that you want to contact them, that's how you would reach them.